We are continuing our live stream, but we're also recording. And since it's Wednesday, the 19th of February, and it's around noonish, it means that it's Fill or Kill time. And Fill or Kill is a daily trading show on Big TV. We air every day live on bigtv.io. And today we're going to be talking about trading fundamentals. We're going to talk about how fundamentals work, how they work vis-a-vis technical analysis, which is often covered here, how to trade political risk, variables, volatility, risk-return probability, chaos like earthquakes, or maybe things like Ukraine. So you have some ideas on trading fundamentals, Sir Ed Metz.
Hi, definitely not, definitely not, sir. Yeah, thanks for stealing my outline, but a good intro, good intro because it kind of
Yes.
nails it. By chaos, I didn't mean chaos like earthquake. Oh, I suppose I see what you mean now. By chaos, I'm actually meant chaos theory because what the problem is when you talk about something like fundamentals, you really beg serious questions because immediately, because people like myself who started off with an economics background, went into trading and realized that I couldn't use or found it very difficult to use fundamentals alone and therefore relied on technicals and other factors, etc. It begs a whole debate about the how to what extent you can trade fundamentals, about the link between fundamentals and price and how prices move, and therefore what makes prices move. So you start off with a small subject like something like Ukraine, what is going on there? So you get a good summary, then you get an idea of what's going on and what could therefore happen, and then say to yourself, okay, how does that affect things? How can I trade that? And then that begs the whole spectrum of issues, which is why people like me have kind of given up trading solely fundamentals. I use fundamentals quite a lot, but as more as a framework, as a guideline to ensure I am consistent. Like as soon as something flares up, excuse the pun about Ukraine, I'm less likely to go in and buy um, the currency because I'm more likely to try and sell it in the shorter term and then fade it later.
Yeah.
It's something things like that. And why do you come up with ideas like that? Well, the biggest and the most important guide of all, as people will be tired of me saying, is history. What happens? What's happened before?
Yeah.
Is that a guide to what could happen now? And that's really kind of sums it up because there's lots of different dimensions as to how you can trade fundamentals. There's a great quote. I mean, I think we should start with this quote from a very great trader, a guy called Bruce Kuppener, Caxton Associates, isn't it? Serious money manager. Someone who quite clearly looks at macro trading, looks at the fundamentals, looks at positions, but also uses technicals heavily. And
Yeah.
he's basically saying that any fundamentalist, that sounds more like a sort of it's not. I never use the phrase fundamentalist because it has all sorts of other connotations. But a fundamentalist who doesn't pay attention to charts is like a doctor who says he's not going to take a patient's temperature. Well, you can get away without taking a temperature, but you're far less likely to diagnose the patient. You're far less likely to find a successful trade, and it is all about. At the end of the day, it's all about taking these ideas and translating them into trades with good risk return and probability that will generate a profit. And that's what it's all about.
But do
So
you
it
think,
begs the
I just want to also talk to you a little bit about fundamentals in terms of, because you had such an interesting double career. Because at one point you were a politician where everything is in a way fundamental. And you're very media savvy, you write a lot, which is also often a fundamental kind of a story. It's often like it's a good story. I guess that's one of the reasons why people care so much about fundamentals. How do you see that? Because you have seen this from all
Easy, yeah,
sides.
well, it's easy access. I mean, not everyone, but a lot of people start. So certainly, people coming into the market, certainly in retail, because the chances are they're reasonably intelligent. They've got an idea of what's going on around them in the world. Probably, if they want to get into trading, that's almost like a premise or a prerequisite. So they come in with a narrative in their head, and then they try and translate that into trading. So it's an easy access point.
Yeah.
The problem is the easy access point also leads to a quick exit. They realize that, trading, finally they see that something's happening. There's a great quote from Ed Sekoita, our friendly banjo player. He says about later, by the time that can you jump, or how
Yeah.
flexible are you?
Very flexible. Just need
If you want to put up the Ed
Yeah.
Sekoita quote, it's a good one.
Yeah.
Because he's saying quite often by the time you discover what's happening in the fundamentals, do you want to read it out? It's too late.
While fundamental analysis may help you understand how things work, it does not tell you when or how much. Also, by the time a fundamental case presents, the move may already be over. And that's something I just want to, since I read this out, I just want to point out this is something I've seen so many times in my previous career as a journalist, where the fundamental story, you're always chasing the move. I've almost never seen fundamental big moves actually cause.
That's interesting. Yeah. Well, there is. I could. There's a lot on that very subject. There's a lot of stuff that I'm not going to divulge everything. Some of the things I use.
Yeah.
That and it's funny you say that, because there is definitely an analogy with politics about how you work an issue in the media, how you've got to be ahead of the issue, always ahead, so you can anticipate when it's going to drop off, and you leave. It's like passing the brick to your opponent. You can have that dead issue that's going to weigh you down. And the same thing with markets, about anticipating what's going to happen, or what could happen, or what's happened previously, and therefore what is likely to, what the market is likely to do as a consequence. And the problem with fundamentals is, if you stick purely to price action, then you're dealing purely with price action. When you start trading fundamentals, you're not just dealing with fundamentals, you're also trading with price action. So you necessarily increase the variables. And because, again, I'm kind of like summing up the show already, there's so many variables within the fundamentals, and some of those aren't proven, and some of them are, and some of them, when it's not clear about the time lags, and some of them it is, that you reduce the probability of your outcome being successful. And that's why so many people come into retail, come in trading, with a clear idea of how they think the market should work, the world works, and they realize that's not how they make money.
Oh, I think you pinpointed there exactly the problem people will make most of should work. And so many people sit there and you have your choice, sell, buy, choose asset class. Like, you have those choices. And they sit there and they talk about the Fed is destroying this and that because their system doesn't work, they're buying the wrong thing. And the world is the world. You can't do anything about that, especially as a trader. So I think thinking how things should be is got to be devastating to your P&L.
The phrase I always use is no good being right in the wrong market. And your arguments could be right, your whole analysis could be right, but how you translated that, or how that is translated into market action, and also your trading strategy around, means that quite often, certainly for the novice, they find out the hard way. Yeah. And that's kind of one reason for doing this show, or talking about this issue, is to blow through the easy access points, because trading is very easy. I was going to say pick up a phone. Very easy to press that button that says sell or buy, and find out that in fact all your analysis, all your thinking is kind of wrong. And that's how why I wanted to pick on Ukraine, because it's topical, it's of interest, but it throws up some really good big issues that I think are useful, certainly to new traders. But I think you should never stop learning. So it's useful to anyone trading. Or even, and let's be fair, I mean, one of the reasons why we get so many people interested in the fundamentals is because so many people talk about it. You look in your newspapers, how many times do you see the FT lead with a chart? They're saying this is an up channel and it's overbought and this is the indicator. Never.
That's a great point.
It's because it's boring as hell.
Yeah, economics can be boring.
Well, it's not, it is.
But this is like Greece.
Joe Public, a chart with an RSI or stochastic or oscillator or wave count, God forbid, is one that's not going to, they're not going to understand, so you're going to lose them. It's not accessible. It is very dull. I mean, don't get me wrong, I love markets, and that's a reflection of a market. So for me, it's not dull, but from a newspaper reader point of view, it's dull. Whereas if I tell you You know, the reason why is several hundred people sadly were killed yesterday, and this is what's going to happen, etc. And it's really exciting. And we put someone on the spot, K80, you know, with exocets going past, whistling past their ears. That's exciting. And yet, you know, how do you that's how you sell papers. That's how you engage people and get them interested. And then you say, well, let's put that chart for them. No, let's just go out there and get involved because it's exciting.
Yeah, but
And
don't you think that's
the
why the
problem.
1929 chart became so popular? Because it is an exciting chart. It's like this is the future and it's gonna collapse.
Oh, bears make money, bears make noises, bulls make money is the cliche,
Yeah,
but it's true. You know, you look at the noise in the last 2 or 3 years. People have been shouting the most. Those people think it's going down,
yeah,
and the people at the bullish people don't really need to shout that much because they're just sitting with it. Thank you very, very much.
yeah. You're right.
You know,
But just look at this.
uh,
What we're seeing on your left is live images from Ukraine, from Kiev right now. It just, I mean, I understand why this is what people are talking about in markets or in general. I mean, it's a
well,
war zone.
I mean, it's very dangerous territory there. But I remember 9/11.
Yeah,
In fact, I was talking to someone. In fact, someone I've mentioned indirectly on this program before. Quite a big, seriously big name. I was talking to someone as it happened, and
oh no.
just he was because he was staring at the event, Twin Towers, and it was interesting to see people's reaction about whether they should trade it or they would trade it. They had positions, what they were going to do, etc., etc. All these moral issues came to it.
Yeah,
So, you know, that's the first point: is do you want, you know, is there a moral question about trading political events when you know it's someone's misfortune,
yeah.
someone is, you know, there are people dying or whatever. Should you be trading? Should you be seeking to exploit that situation? I mean, that begs serious questions that I'm not going to go into today.
Yeah.
But let's focus. Let's
But
focus
that's
on, you know, the trigger
yeah,
for our conversation today is fundamental events, fundamental risk, and Ukraine. So I think before I go off on one on the ethics of situations like Ukraine or media reporting of it or trading of it,
yeah.
let's see some of the action.
Let's see some of the.
Action. Do you want to run that video of
Oh yeah.
what was?
Well, I can air it again. I've been playing it a little bit in the background here, and it's
The one
just
with the fires? Yeah.
yeah, I have it here.
There's a commentary on it, isn't there?
Yeah.
So the point is there is a attempt of it's not an attempt, it's a crackdown of Maidan by the police using water cannon and coming into the building with the police while the people and the opposition leaders are urging the police and the riot police and the forces to stop because there are two issues. We know that the people were dead and there were the clashes within the city and the people who died with the fire guns. But then the people left to Maidan and the people there are injured people in the hospitals, but the downtown is blocked. So there is no really necessary help can be given to the injured as people can't get into. And there is no. We also heard just the news with the Ukrainian media. We're checking it about the first victim, the first person who died at Maidan.
It's devastating footage here.
Yeah. Yeah, it's very sad, and sadly, there are far too many similar events that have been the last few years. There always have been, and always will be.
Yeah.
You know, I'm going to put aside, I'm going to suspend the whole ethics question, and talk about how you trade events like that. The first and foremost thing is what this does is it's uncertainty, and uncertainty breeds volatility. So immediately what it does, it creates an instability in the system, and you ask yourself, where is that instability going to be felt most, and where could it spill to? So, you know, direct and contagion. Well, obviously with Ukraine, how do you pronounce their currency? It shows you how much.
Yeah, I wanted to ask you that same
I
question.
got no idea. Hryvnia, like Slovenia.
Well,
don't
I
know.
guess we could find out. I've yet to hear anyone mention the
Well, it's easy
Ukrainian
not to
currency.
mispronounce it. No one wants to mispronounce it, but I'll put
Yeah.
my hand up. Well, I may have heard it talked about, but I can't say I've ever talked about the Ukraine is much easier to say and doesn't highlight the fact that I've got no idea how to pronounce the Hevenia.
Yeah.
I don't know. Apologies to anyone from Ukraine. But it's so let's look at what's going on. It creates instability, uncertainty, and therefore the impact itself on the country, and therefore then you can start talking about the impact outside. Ukraine, let's get this right. I mean, Ukraine is, you think of it as a well-developed former Soviet Union country with a well-developed economy,
Yeah.
and yet something like the Russian economy, I think I could be wrong on these figures here, but I think average GDP per head in Russia is 6,900, which is surprisingly, I think it's surprisingly low. In Ukraine, it's 2,000. So they're almost 3.5 times the level of GDP. So it reflects the the type of economy that it may be, and therefore, one, you could say it's fragile, but also how small, and therefore, in two ways, you'd think, well, that's not very big, and something like this could rock it. Well, if it's a small country where it's such a relatively small GDP, then an event like this could be even more devastating, particularly if it attracts risk speculators as well. It becomes very, very vulnerable. So on the one hand, is to say, well, it's too small. Stuff like this has no impact. But we're dealing with something that small, where today's trades in the Hevenia or the Ukraine.
The Ukrainian currency, you mean?
Suddenly it could be like 100 times the annual volume in that currency, and therefore
Wow.
who makes a market in it, what type of spreads they're making in it, how do you trade it? These are all really important questions before you even consider taking a trade in a currency like that. And then you say to yourself, you look, what else is trading? I'm sure it's the Russian banks are the biggest source of liquidity in that market.
Yeah.
And then you ask yourself, what impact it would have on neighboring countries like Russia, and whether it's sustainable. So often you see these events are flashes in the pan, and sometimes they're sustained. They sustain themselves. We were talking about an event, something else yesterday, which can sustain itself if it's not handled properly, and that's the imponderable. You can take a guess and say that this market is going to continue to Ukraine is going to continue to weaken, while there is uncertainty, and the more these fires and these and everything continues to flare up, there's going to be increased uncertainty. It will attract sellers into the market, and given the size, it could have a massively disproportionate effect, which in itself will attract even more sellers. So you would think immediately that, compared to something like the ruble, if you were thinking about how you could play this, you'd still be a seller of Ukraine against the ruble almost on a size issue alone. But then you have to ask yourself, is it sustainable? What is the outcome? Maybe this is just a flash in the pan, and it's going to be over tomorrow, and things will be resolved, and we'll look for the next flare up. And that's an imponderable. The probability, I don't know, and therefore begs the question: how do an event like this? How does it impact the markets? Well, we talked about the issue of size and the volatility, but there's some great work actually. I was looking at this work I wasn't aware of before with my broken glasses, with Martin Evans. There's a study by, I think there's a plate about this, Martin Evans and Richard Lyons.
Yeah.
They did a study in 2004 that said the market could still be reacting to news events, a matter of hours, but also months.
Yeah.
Now, why? Well, there's a simple reason. You're talking about the weight of money and the decisions behind the weight of money, and what influences the decision makers. And are they people who were thinking? Let's say people who'd started to invest in Ukraine before this problem. And now they decide they want to pull out. They want to sell their assets. But they may take a few months to do that. Maybe just people have been gone in for a punt, thought it was overdone, wasn't anything much, and they're out of it. So the impact of a political event or any sort of fundamental event can be almost immeasurable in terms of its time duration.
Yeah.
And you'd say to yourself, what are the indicators then that for any fundamental decision? Well, in currencies, a lot of people, it's interesting that you don't see many people talk about this, but clearly the biggest, or what should be the biggest determinant of a currency's direction, in my opinion, traditionally you used to think trade surplus currency would move to ensure the surplus or the deficit was removed. But effectively, in an investment economy, it's the interest rate differential between the two currencies.
Yeah.
And so you say, well, what is the interest rate differential in a situation like this? Well, clearly there's a massive risk premium attached to the Ukraine, so their interest rates would hike in order to deter people selling it and also to attract any sort of funds. And so that would blow the differential theory immediately. And then you ask yourself, well, what is the evidence for interest rate differentials over time anyway? And then you look at papers like there's another paper, I think it's there. Is it by
IMF?
by Martin Evans? It's quite interesting. This guy is he's obviously an academic type figure from Georgetown University. I can't read that, even with broken glasses. Can you read where it's underlined?
Variations in current and expected future real interest differentials have played a very minor role. Dark matter has been the dominant driver of real depreciation rate. Nature of this dark matter, the risk shocks driving household habits, exchange rates appear disconnected from traditional fundamentals because they're particularly susceptible to risk shocks.
Okay, because you were reading that out. Basically, you're saying that there's evidence says there isn't much of a link between currency movements and interest rate differentials, which is would be a shock in itself if we hadn't already guessed that from hard experience. One of the reasons why is because of, and this begs all sorts of questions, dark matter. In other words, the reason why currencies move is for reasons we don't know. Well, the reasons we don't know, the dark matter, are all the host of variables I've referred to before, the fundamental variables that affect households. In other words, real people, real economies, and that affects currencies more. So economies doing well because all these variables going on, doing badly, all these variables, then that's going to affect the currency movements. Can you put that up, back up?
Yes.
And as a consequence, it's because, for that reason, that it's very difficult to find close correlations, fundamental correlations with currency movements. And therefore,
Don't you think that's very interesting? Because this goes against a lot what you learn in classical economics.
Goes against, back to that newbie point about retail, about the first thing you think is that fundamentals move, and therefore fundamentals in currency markets are interest rate differentials, and forget it all, it's dark matter. Hello, Darth Vader.
When you say dark matter, you mean stuff like flow, for instance.
No, dark matter means what is dark matter in space? You can't measure it, you don't know, it moves. It could be a whole load of things.
Exactly. But a bigger one would be flow for whatever reason. Like
flow. Flow.
Bang.
Dark matter determines flow, doesn't it?
Yeah.
So,
but
the dark
interesting, like could be compression, like it could be.
Maybe I haven't read his paper in full, so maybe I'm doing the guy a disservice. But what he's saying is actually very important, very interesting.
Yeah.
And what he's referring to, I think, again, without having read it, is dark matter is dark because there are so many variables that can drive a market at any one time. And there's a point made time and time again. And the difficulty is finding that variable. And so when, if you can pick the variables, the key drivers in a market, you'll have, I think, a far better chance of succeeding in trading and everything related to markets, because you'll be getting closer to the probabilities, the things that are going to move the market. Whereas if you stick with one approach, you might absolutely nail it one day and miss it the next. So if you can understand what's driving and then say what tools work with those drivers, then you stand far more chance. And what he's saying is forget interest rate differentials, just recognize there's a mass out there.
Yeah.
A lot of that mass has to do with households, real economies, small microeconomies multiplied into macroeconomies. So understand that. and then you stand a better chance of actually realizing what moves markets because it's difficult to measure over time. And this is the problem is with fundamentals. It's essentially is identifying the right variables and then finding the linkages and finding how they're reported and what that really means, and then taking that to a market. You know, a stock market is by comparison is relatively easy compared to a currency market in that sense because you've automatically doubled, I assume, doubled the number of variables.
Yeah.
So when you're using fundamentals, it becomes much harder. So this is why, is my point, is I use I use a whole host of different factors.
But we did
But I
have.
use Dennis Gartman. I'm no disrespect to Dennis Gartman, but he's got loads of rules I disagree with and I don't like. You just before you put that up, one thing you'll hear, you hopefully will come clear from me is I utterly detest the approach that one size fits all. One approach will work to the detriment of others. You use fundamentals, you're wrong. You should use technicals. You use technicals, not fundamentals. You're wrong. I think one that is misses the point, but actually is not only patronizing, but it's also misleading
Yeah.
because the people who trade on fundamentals can do phenomenally well because they're very good at what they do and they've picked up enough of the variables I've referred to, enough of the drivers to make it work. In other words, they sold the heck out of the yen last year, the last 2 years, and done very well on fundamentals, thank you. Whereas a lot of technicals, RSI sellers were getting stuffed. Where someone in the fundamentals could be saying, well, this should be happening, and yet it isn't because there are reasons explained in the charts, five-way trend sequence against them, or whatever. The RSIs are too overbought, whatever. And to say one approach is wrong, whereas the other is right, misses the point completely.
Yeah.
And it's a question for me. What I try and do, because I'm that type of trader, what I try and do is find something that works. So I'm looking for the drivers behind a situation, behind a market, and then I'm following those drivers. Now, I might get that wrong, in
the
which case
best,
I could well get everything wrong, but it's also a question of using what works for you.
Yeah. But the best trader I know.
Now, if you're
The best trader I know said, "I will trade tea leaves if it works." Like anything. Trading, it's you, any
that's
tool.
pretty grim. I went to Harry Potter Land on the weekend, so
I have a video. Do you want me to play it?
oh, go on. Yeah, I didn't. Yeah.
Okay, now you're springing it on me, so give me a second here.
Well,
But
let's talk. You put while you do
no,
that.
but while I'm bringing it up, I want to ask you something about. Let's see here somewhere. I want to ask you something about a thing you just briefly touched on, and you just leapt off of it because we have a situation in the recent past where all these indices stopped reporting when you had the government shutdown in the U.S. with all these like macroeconomic numbers you normally get, which a lot of people appear to care very much about, all of a sudden stopped coming. And so we had this rare opportunity to actually see if it mattered. So my question is, I'm springing this on you. I'm sorry about that, but did it matter?
Well, yes and no. Markets are traded by people with different time horizons. So some it would be important on a day-by-day basis. If they're trading fundamentals on a day-by-day basis, they have no means to trade. One assumes if there's not any source of information. People on a wider time horizon, they don't need short periods like that. It's not going to matter if they don't have it because it's a much wider narrative they're following. But begs the question again: does it actually matter? Does one set of figures matter? Surely it's the series of figures that matters, and then do they matter? Because often they're revised after the event. We tend to rely also on anecdotal evidence, our own evidence.
Yeah.
And we often, it begs a question about price. I'm going to spring. If you're going to do something like that, I'll spring a quote back at you. You can use. But let's. Have you got that video ready?
The video is, if you could resend it, I sent you a little note. It's on the other computer, sadly. If you can just put it on Slack, that would be great. Because we have this great video of Ed at Harry Potter Land. Is that what it's called?
Just me, but if you want to put a Dennis Gartman quote, or
Yes.
I'll read the Dennis Gartman
No,
quote.
Dennis Gartman is right here. And it's
Okay.
rule number 10. To trade successfully, think like a fundamentalist, trade like a technician. It's imperative that we understand the fundamentals driving a trade, but also that we understand the market's technicals. When we do, then and only then can we or should we trade.
Okay, I absolutely, and for someone who's just slated the guy, but he's got about 100 rules, some of which, you know, he's probably got the back of a Kellogg's cornflake packet, by the looks of it. In my humble opinion, that's a real put down. But on that one quote, he's nailed it for me, because
Yeah.
that's exactly what I've been talking about and what I do. You know, it's, for me, the fundamentals, the fundamentals tell me where I'm going, my destination. The chart tells me how I get there.
Yeah.
It's the map. Yeah, and without the map, I could get completely lost. Without a destination, I don't know where I'm going. So for me, the combination is essential. But that's me. Look, if you're a quant guy, if you're trading RSIs, if all you do is you have one technique, you're an intraday scalper, who cares? You know? So for someone like Dennis Gartman, for me to tell you how you should trade, it's not just patronizing, it's very misleading. Not least because a point I made elsewhere and before is that you need a trading system that is suited to you. So if you're really weak, say on fundamentals, and you don't understand, or they just confuse you or whatever, then clearly you're not going to use them. Or I hope you don't use them. And clearly you're going to use a different system. So use that system, and if it works, then keep on using it, you know, or try to improve that system. Don't, you know, trade from strength, don't trade from weakness. And so, you know, for someone like Dennis Gartman saying, this is how you should trade, come and spend, you know, whoever says $3,000 to follow my approach, because my approach is exclusive and it's unique and successful. And you've got to do it all day long to do it, and yet you're holding down a job. You can't do that. It is completely at odds with your whole psyche, so you're not going to be able to sustain it. And in fact, that one approach may not be right in tomorrow's market, may be right in today's market. And, you know, there's a whole host of variables that is wrong for any one person, for me to tell you, I think, how you should trade. I can advise, and looking at how you trade, I reckon I could help a lot of people with the style of the method they should use that would suit them best. But for me to tell you, this is what you should do, without knowing how you do things, then is wrong. So.
Yeah, I think you're absolutely right. And I think if you read, that was the thing I had hardest time understanding about trading, because when I got into this sort of game in a way, was that every person I talked to, every piece of literature, everything was always the same, like the same start. It was always the same, like reading Market Wizards. Everything is about, you have to have a system that matches your personality. So the first question you say is, what kind of person are you? Are you contrarian, or are you a trend follower? And you start like that, and you find something that works. And I think the reason why I fail as a trader, I'm a terrible trader, was because I didn't fully appreciate that aspect of it.
Yeah, but in itself, then you know, trend follower, contrarian. I think again, why do we make the world so black and white? You know, there are nuances. Anyway, have you got that video, or shall we move on to a great line? I think. Do you want to put up Jim Rogers' quote?
Yes. Oh, that's such a good quote. I'm not sure I agree, but it's a good quote. I have never met a rich technician.
Well, look, it's interesting. There are many rich technicians. But what is really interesting, someone who pointed this out to me the other day, and he said, he's a guy who does Elliott Wave like I do, and various number of techniques. He's a good Elliott Wave. In fact, he said, look, he hasn't been around that long, a few years, 3 years, I think, but he's followed some good people. And he said, look, a lot of these people, I'm sure they use Elliott Wave, but they never talk about it. Now, the answer to that, and I said, was either they're just instinctively in tune with the market, and the Elliott Wave theory or approach is in tune with that particular market at that particular time, or you're absolutely right. And, you know, someone like Paul Tudor Jones Paul Tudor Jones on record. I've got the video of it saying, Peter, his mate, saying it, saying that they use Elliott wave theory and they use analogies, which is two of my major tools, and he did very well using that approach. So a lot
pretty
of
rich
people
as well.
do use technicals, but you wouldn't have thought necessarily you talk to them, they don't talk about technicals. Again, going back to that point about the FT, it's dull as hell, it's dull as ditch water. You don't want to talk about technicals. You don't even want to engage people. Or you can talk about 1929, but again, that's not quite so technical, is it? That's a narrative. And so a lot of these people who are very good, very successful traders, proven successful traders, may use charts, may be technical, but they haven't actually don't actually talk about it because it's not necessarily the way to engage people. But as a direct response, Marty, Buzzy Schwartz, I never heard him referred to as Buzzy Schwartz, Pitbull trader, isn't he? Do you want to put up his quote, Marty Schwartz? Because it's a direct response to Jim Rogers' quote.
Yeah, he's the guy with the phone, right? This guy. Oh.
Do you want to read it?
I always laugh at people who say, I've never met a rich technician. I love that. It's such an arrogant, nonsensical response. I use fundamentals for 9 years and got rich as a technician. There you go.
Yeah, there's he's an interesting guy, Marty Schwartz. What's the name of his book?
Wall Street Trader, is that the one?
Yeah, I think so. I don't know. I haven't read it. I know it's on my list to read, which I haven't got around to reading it as yet. You just asked me a question about that video. I don't know.
I'm sorry. Oh, it's yeah.
I don't know where that. Yeah, okay. I'll show it another time. Whatever.
He received national attention
so
when he won the
ding dong, is the technicals right? Is the fundamentals right? And there's no right or wrong answer to this. And so it's if you take Ed Sequoia's point, or by the time you resolved the issue in terms of fundamentals, you're sure what's going on. It's often too late. Your charts won't necessarily encapsulate what's going on, but it's a reflection of the supply and demand. And this is what we're using. We're using proxies. We don't know the linkages. Economics is too young a science to be fully confident as to what the linkages, the relationships are at any time, and yet particularly at any one particular time, say like Ukraine, how it's going to work out, what impact it's going to have, and therefore we can make some guesses. But what we try to do is find proxies that will help us.
Yeah.
And those proxies are best reflected, in my opinion, by supply and demand, which is graphically represented by a chart. And that is, for me, it sums it up. And if you put up the quote by Charlie Faulkner, he takes it to the next stage. You read that out because I can't.
The current proliferation of electronic technologies, computers, the internet, cell phones, 24-hour news, and instant analysis tend to distract us from the essentially human nature of markets. Greed, hope, fear, and denial, herd behavior, impulsiveness, and impatience with processes. Are we there yet? Are still around, and if anything, more intensely so.
Yeah, very, very true. And then it comes down to decisions made based on a chart, which are based on the fundamentals. Decisions are driven by the sentiment, and therefore the sentiment surrounding the fundamental event then becomes key because it drives everything. And then you ask yourself, well, how is that sentiment constructed? We talked yesterday. Remember the George Soros reflexivity?
Yeah.
About how fact goes from fact to perception, from perception back to fact. It's a not just self-fulfilling, but self-perpetuating and self-exaggerating. In the case of something like Ukraine, I alluded to what could well happen, and what I think will happen. We'll get onto some of the charts in a minute. Is that people will go after this, and because it's a small economy, it's going to be in real danger, because people will go after it, and the flows could be potentially massive. There's going to need Russia at the very least to step in, to help and defend the current market like that. and then becomes self-fulfilling, because then the currency weakens. You've got a crisis. How do they deal with the crisis? There's a flight of capital, investment is going out of the country, so that's your longer-term future stuffed. In order to stop that, you penalize the speculation, you whack up interest rates. So if it was not the investment future, it's your interest rate bills now going to bury so many businesses. This was once a small, fragile economy is in serious trouble. And that's going to, there's a further flight away from the currency. It's all self-fulfilling and self-exaggerating, which is, George Soros's point. Curiously, George Soros was described by Time magazine as the modern-day Robin Hood, whereas a lot of people have referred to him as just the opposite, because he tended to pick. Speculators like George Soros have picked on the Ukrainians, given that he's Hungarian, it's possibly a bad example, but he's picked on countries like that as a means to making a quick buck.
Yeah.
So bring that all back, I think, this is how I approach a market. My pennyworth is, if you want to put up a chart, it's my FITS chart.
Yeah, I like that a lot.
Well, it's immediately a wave pattern. Well, if you doesn't need to be a wave pattern, but I follow the market. I use what I call a best fits approach, which is the fundamentals. I need to be consistent. The intermarket relationships, in other words, understand how the fundamentals are going to work with each other through the markets, back into the markets and backward and forth. The technicals, self doesn't need explaining, and the sentiment, the fits. When I do a trade, not beyond, say, today, then I use the best fits approach. I try and find something that's going to work that ticks all those boxes in each and every stage. And if once I've got that, then for me, I've got my probability attached. I've got a good idea of what I think is going to happen, and I would argue with a wave patterns, it gives me a risk return. And that gives me a way to trade a situation like Ukraine, because I can then assess the risk and I can assess the probability. And this is the biggest point of all when it comes to trading fundamental and political events, is I start out by saying the two things that happen is uncertainty. So necessarily you're reducing probability, but also the volatility, the extent to which you can make money but also lose money increases. So it skews, it changes what for me is a key metric, is the probability times the risk return. If you want to put up, there's a great quote there from Peter Bernstein.
Yep. Oh yeah, that guy. Who is he? I don't know. I don't know him from before.
He looks like what's his name? I was going to say was it Glucklich the other day? He looks like his best mate or something. The 80-year-old trader.
Yeah, I just love guys like that. They're so much knowledge, and it seems to be a fun guy. I don't know why.
Well, there's surprisingly few young people in these lists of quotes we get, but then that's really no one wants to listen to someone who hasn't made money, and therefore the chance of they've made money and they're really seriously good. They made it over a long time, therefore they're going to be older, one presumes, and also, quite frankly, they're probably got better things to do until they're retired and they want to pontificate.
One exception is maybe Paul Tudor Jones, who was sort of a quote machine when he was 30.
Well, a lot of young people have made serious amounts of money. We've all been there, done that, got the T-shirt. Well, no, there are lots and lots of young people have done phenomenally well. And middle-aged people and everyone. Yeah, I mean, and women and probably even children. Yeah, it's the great thing about trading. It's very accessible to all sorts of ages and kinds and types for all sorts of different reasons.
Yeah.
And it comes down to the point here I'm making is risk management. When you have an event, the great surprise and shock is endemic to the system, and people should always arrange their fares so that they will survive such events. In other words, don't take the risk unless you can quantify that risk, unless you're sure you can control it, which is why I often don't trade events like this, because my risk return, I'm not, I don't know that it won't gap higher or gap lower, and therefore I can't necessarily quantify my risk, and therefore it makes my the chances of me taking the trade, my metric, being skewed immediately. So what I would do, the obvious golden rule you see so many good traders do, is when the risk is heightened, you reduce your position size, which is one reason I use my metric. It actually helps determine my position size. if I want to take the trade. If I think that the risk return times the probability of this event carrying high, making money for me by, say, selling the Ukraine currency or selling the ruble as a surrogate, then I need to understand my risk return. And then if I think there might be a danger of a risk, I need to quantify the risks of the size of the gap, how much it could bury me, and then I can trade accordingly. But if I don't do that, then I'm not going to take the risk because, why, my risk return has to be so skewed in my favor to avoid being absolutely crucified.
So,
But that's the
and that's often like a story like that is just never told. The fact that you don't trade fundamentals, and that doesn't get the newspaper headline. Or you can always find some guy.
Well, today, it doesn't make for a good headline, does it? Well, it kind of does in an interesting way, but not to. Today, no one traded the Ukraine because everyone was frightened of taking the punt, taking the risk, which would probably be about the best news possible, except, and this goes into a whole different area, the price. My belief is that prices will move without being traded. It can and do move without being traded. So, for example, let's say the proverbial hits the fan tomorrow, happens overnight, Ukraine opens its 5% lower, no trade is being done. There's a gap in the market, and yet no one has traded it, and yet it's moved on no volume whatsoever. And then the news deteriorates, no one does a trade, it's gone 5% even worse. Until eventually a trade is you need the trade ultimately to say the market's there, the market has been there. But it begs all sorts of questions about what actually determines price. And it goes back to the same point. Why do we use technicals? Why do we rely on technicals as much, if not more, than the fundamentals? And the simple reason is history.
Yeah.
I can go back and look at the Ukraine charts over history and see what it's done, the extent to which it's gapped in similar events, and calculate what historically my risk has been, to take a view. But more importantly, in events like this, I look at how the currency or that market particularly has reacted, or similar markets have reacted to similar events, which begs the whole question of one of the approaches I use is not fundamentals, fractals, and how the markets have a habit of repeating themselves. There's a great Jesse Livermore quote. Do you want to put that up and read it out for me?
I sure can. I absolutely believe that price movement patterns are being repeated. They are recurring patterns. They appear over and over with slight variations. This is because markets are driven by humans, and human nature never changes.
Yeah, human nature reacting to fundamental real events, the way they react doesn't change. Now, can you put up one of my favorite charts? I always cite this one as why, to show that markets can move over time in a similar way to similar type events. You put up the Japanese one?
Oh yeah. Japanese earthquakes.
Yeah, you've got 3 earthquakes there. And this is dollar yen reacting in 1923, 1995, and 2011. The 3 big earthquakes of the last 100 years. And yet it's produced, prior to it, which is really weird and bizarre, prior to it the yen was strengthening. Then you got the earthquake, which, there's a whole causality issue there, but we'll leave that one alone because that's too freaky. But after it's happened, the immediate response is, you would think they would sell the currency, wouldn't you, on an earthquake, because that's severe? No, the first thing they do is the currency strengthens on liquidation. They need the funds. So the yen is actually, as people are repatriating yen to Japan to meet the crisis, the yen strengthens. And then it enters a major bull market, or a major yen bear market, which is what we've seen since 2011. Which is really kind of freaky, and the story continues. And just in case you're interested, the fractals continue, and I believe are continuing. But it's saying that when you have a fundamental event that's not predictable, arguably, that's the consequences are arguably more predictable, and you can then go back in history and say, what do certain markets do at certain times? And you asked me when we started talking about this. You started mentioning about, can we do a Greece? Look at it from a Greek point of view.
Yeah.
And I was thinking, well, they're kind of very different. But so I looked at it. I looked at Greece and I looked at Ukraine. Do you want to whack up the Ukraine Greece chart?
Let me just 1 second. It's a little bit. It's one of the last ones, right? This one?
Yeah, one of the last ones. That's
Sorry.
it. Which is kind of freaky on one hand, I think. You see how obviously the bluer colours the Greek stock market and the black is the Ukraine stock market since 2008, and it's matching it pretty close. And the interesting thing is, I would argue on that basis is it hasn't got the last sell-off in it. I can see myself where the chart is, so this is kind of difficult on that basis. But it looks to me like it needs to smash through the lows on that fractal, and then it could recover.
Yeah.
Which is really interesting. Except there's a big proviso. There is a difference between the Ukraine and the Greek stock market. And what do you think that difference is?
Do tell.
If there's a crisis in Greece, or there's a crisis in Ukraine, the currency will move.
Yeah.
If there's a crisis in Greece, the currency, the Greek drachma can't move because the Greek drachma
Doesn't exist.
doesn't exist. So the euro could move, could end, whatever, Grexit or whatever.
Brexit.
So the problem with that is when you start reducing the number of variables, you actually put greater pressure on those variables, particularly if they're financial markets and they're tradable. And then the stock market arguably would take a bigger hit. The stock market has to do the adjustment or the real economy ultimately will have to do the adjustment because it doesn't have a currency that's arguably doesn't have a direct close enough a link with the currency for that currency to reflect the fundamental shift. Yeah. So you could say that in fact the situation in Greece was worse because the stock market took a greater hit than
the reason I'm comparing
I think,
it is just the visuals are so similar. So I mean these demonstrations in the streets are often it's just interesting
yeah.
the similarities, but I guess
it's right. I mean, it's the worst thing of all, always for any market. It's one of these self-fulfilling, not prophecies, self-fulfilling maxims or observations. Is that markets hate uncertainty. So as soon as something is uncertain, you just sell the shit out of it. Yeah, I'm sorry, excuse my language, but yeah, I mean that's just what you do. It's just go for it, go after it. It's uncertain. When they resolve it, you had situations, and funnily enough, to do with Greece and other European zone countries where it got into a completely different play 2 years ago when there was bad news and people were waiting for the resolution. The market, the euro, would actually go up, waiting for the resolution and fall on the resolution. It was kind of an interesting turn.
Yeah, that's right.
Which is not, but I think that's to do with the sentiment. That's going back to George Soros's from fact to perception back to fact. But in this case, fact to perception back to fact to perception to fact. And it gets really kind of complicated. So there's interesting though. Your intuitive approach is saying let's have a look at Greece. Is there a similarity? And then that's the fundamental fractal that's going on that is worth looking at. Yeah. And if you look at Greece, and if it's in my belief is the Greek stock market is it looks really attractive. And if Ukraine follows the same basis and Greece continues to go up, we've got a map we can use to trade the Ukraine stock market. Now, there's a brave man. Well, let's look at the currency then. What has the Ukraine been doing currency-wise?
Yes.
It's the one with Russia and
that's an interesting
Euro half, the Hungarian.
This is the 2008 one?
Yeah. Now that is really interesting because you talk about correlations. Well, no surprise that Russia, Hungary, and Ukraine are heavily correlated currencies.
Yeah.
And so saying they're moving together, they're all in triangles, which is arguably a continuation pattern, but it's an explosive pattern that typically produces a very sharp, but often a sharp but short-lived thrust. You want to see a triangle, then have a look at dollar yen for the last 6 months beyond previous and went to new highs, but it's come back in the range, begs lots of questions. But If you look at that and then say, put it what's the context, then you start to see the difference.
Yeah.
And that's, um,
That's
I would argue
1996.
it's a reflection, I would say, how I would describe that. The one at the bottom is Hungary, then Russia's the middle, and then the orange one at the top is Ukraine. What we're seeing is a reflection of risk, political risk, and therefore uncertainty, and therefore a risk premium in order to attract people to the currency. The currency has weakened significantly. There's a big difference. Same price action. It's an interesting study in fractals, this, because there's the same price
But
action.
we do have one thing that's different now that Ukraine has a currency peg,
Okay.
and one thing we're not looking at. Just that's the reason for the divergence after the drop. It does have a peg, but I think you're right in the risk, regardless.
Well, it's under a lot of pressure, which is if it's pegged, then it increases in even more pressure, and then you can start to trade. Presumably, there's a forward market, and the forward market would reflect again. If you peg something, let's say like the Greek drachma doesn't exist, your euro is your peg, it's fixed, it's not going to move with the fundamentals. If you have a peg, something has to give.
Yeah.
And what will give will be the interest rates and interest rate differential, and therefore the futures price, or the real economy, or potentially the stock market, which
Yeah.
if there's, if it's pegged and it's limited in what it can do, then that'll be reflected in how in the stock market moves. And then you can trade, if you're looking at something like both, you see what I find interesting, both the Russian ruble and the Hungarian are following templates, fractal templates, doing something very similar but at different stages in different positions. So you can go after something like the Ukraine, go after the Russian ruble, in the belief that it's following a pattern set by gold.
Yeah.
If you look at, you want to put that chart going back to the BRICS chart, all the BRIC currencies have been following the same template, same type of pattern, same movements.
But I
You
also
can
want to
see-
say it's just more on the peg. I mean, they're effectively abandoning the peg now. So market pressures are growing, and I think you're right about saying that it's probably 10 or 100 times volume today than it would have been on a normal day.
Well, it's the same as the ERM. You know, if people want a more, if you like, more domestic. From my point of view, domestic example is when sterling left the ERM or any of the currencies previously, French franc, when they get under pressure, the interest rates go through the roof. There are several ways of playing it. You know, but the difficulty is the central banks, there are going to be restrictions on how you trade it, and they'll seek to penalize anyone punting against it. And, you know, interestingly, we talked about correlations, other markets that will move as these markets move. And so what this is saying to me is they're all following a very clear pattern, following a particular pattern of weakness, or if you like, of dollar strength versus currency weakness, which is what these charts are, which is also following the same pattern as gold. And they're all very major bubbles that are brewing of significant extent, but also in different times. So the Russian ruble is lagging, seriously lagging the South African rand. And I would argue, I made the point before in this program, that the Indian rupee and, say, the Turkish lira, which isn't on that chart because it's not a brick, the Turkish lira, they're very similar and in a similar position. So it's actually Eastern Europe that's been lagging this whole process. And then you say, well, okay, that's kind of interesting. How do I trade that? Well, you can go after them in their own right, and you can watch. You've got to be careful of the interest rate differential. You can want to protect your capital. You can go in the options market if there is one. At what price? That's a really tough one. That's an unlikely one. And so you can trade it in the spot and just keep a note. You can try and do it outright, and then you've locked in the interest rate differential against you. Or you can accept, or you can look at it and say to yourself, well, how will this affect other markets? What are the fundamentals in Ukraine and the bloc represent? They represent a risk to global stability and therefore represent a risk aversion play. Now, if you look at a chart we've mentioned before, which is really interesting, is a comparison of dollar yen with the Turkish lira to use the template again.
Yes.
Have you got that there?
Yeah.
You see the similarities in those charts. That's
Yeah.
risk play again, how markets are moving because essentially the emerging markets are representing risk aversion trades. And that dollar yen is the same basis, and therefore that dollar yen on that chart alone is still in the bull market, which is interesting. Do you have a chart there of the Turkish lira and euro yen in the short term to highlight how the emerging markets are actually moving as risk instruments?
Yes. Sorry, it's just a little. Here you go.
Yeah, this is really freaky, I think. This is a shorter term, last 3 months of hourly data on the Turkish lira compared to the to euro yen. And basically saying that the euro yen's already rallied, and therefore the Turkish lira should do the same, and therefore it's raising a flag that the emerging currencies could also go again.
Can you walk us through? I'm really interested in this. Can you walk us through specifically how you find something like this? Because these are two fairly like.
But you do it. There's several ways, Ferry, without going into a whole masterclass as you described it on fractals. There's two ways. One is through price action, a memory for price action, which, given that some of the approaches I use, like Elliott Wave, is a coding system, an address system, so I know immediately say what did this market do before in this position, and then I've got an address system to find comparable examples. Or you do something like you did with Greece. You say, what has another market or another time done in this position? And you can use the fundamentals. There's a really good chart I found, which is probably easy to construct if I had the time, but haven't and didn't, and I now lost the chart, on the South African rand, on the strikes they had in the South African rand, and the effects they had on the currency. And it's really interesting because every time there was a major strike, it was at the top of, now I don't know how to describe this in non-Elliott wave terms, it was at the top of wave one to the upside. In other words, it started something to the upside. It's at the end of the first leg in the new deteriorating trend.
We do have a
because
daily.
it was so well publicized, too hot, everyone it then backed off. In other words, when you saw the news, quite often it wasn't. There's not this chart.
Okay.
This is a chart that relates the events, the real fundamental events, the strikes, to how the South African rand moved.
Yeah.
It's an interesting exercise if anyone wants to do that, because it came in relatively early on. The market would then go the wrong way, as if they, it was as if they announced a strike and then said, no, we're going to resolve it, so the market goes back, but it's already triggered it. And then you'd get the really strong move later. So what it's saying, if you were to translate that as an approach to say something like Ukraine, you could say, well, today it's a little bit too hot, excuse the pun, a little bit too hot, and therefore you should see it retrace next couple of days, which would provide an opportunity to go in, not necessarily in the Ukraine, but in, say, something like the ruble, because the ruble is at new historic highs today. Is that correct?
Yes, that is correct.
And so certainly, obviously, the Ukraine as well. So they're breaking the triangles to the upside.
Well, the dollar ruble, meaning that the ruble is at new historic lows, of course.
Yeah. Which, from a technical point of view, so let's say the fundamentals. What is it saying? The fundamentals saying, well, politically we've got uncertainty, it's not resolved. We don't know what contagion it may have, not just politically, but also economically, financially, for surrounding countries as a bloc. We don't know. It's uncertain, so that's a reason to go after the currency. It's almost a self-fulfilling prophecy. Fundamentals, we're not sure if we don't know the link, so we can put that aside, but it's not inconsistent. That's where I come from, the consistency point. But more importantly, it's the technicals. It's broken a chart pattern. It's been in that range for pretty much 18 months, 2 years, and it's breaking that range. It's got real potential. And yet I'm saying it's hot. Everyone's talking about it. It could go from here, but there's a chance it could pull back in the next 2 or 3 days. Now, if it follows the same path as history, the South African rand, in more ways than one, then in fact it will trace and give us an opportunity to go after it later this week or into next week, maybe through the weekend, whatever, as the situation deteriorates. And then if we can establish the position, then we can set the target. I'm not going to go into the details, the technicals of the triangle targets and stuff like that. But once you've got a position and it's in the money, you can trade from strength, and then you got a much easier way of handling your capital. You can add to the position, you increase your risk, and your risk return starts to improve. And it's something I did with the South African rand. I talked about that being I was long through short the South African rand through the strikes from just below 850, looking for this move based on that chart you threw up. You're going to throw that chart up again, actually?
Which one? The
South African rand chart.
Yeah.
Based on that, it's the same type of template. It's the same type of pattern it's doing when it goes bananas. It's a bubble. It goes bananas on the upside, and now I should be looking to fade the South African rand. So there's an opportunity. If I'm worried about trading the dollar against it, I could go and do something stupid.
Yeah.
Like buy the rand and sell the ruble, which I say stupid, but it's a high risk.
But would you trade such currencies? I mean,
well,
because the ruble is also partially pegged, and you have these these. I mean, it's fairly exotic to trade rubles, isn't it? Wouldn't you say that? It's a complicated market.
Yes. I don't look. I don't trade. The reason I don't trade these markets, so I don't trade the half. The Hungarian. Some people will be aware I traded this amazing fractal correlation fractal between Swiss yen and the Hungarian. One reason I don't is because of the risk. My risk return is always skewed. I can't control the risk element, and quite frankly, it's not therefore worth the risk.
Exactly.
If it gaps against me, or they start bringing measures that I'm sure of. I talked before about Bitcoin. I wasn't going to trade Bitcoin because of the risk.
Yeah.
Not the risk of losing or being wrong on the trade, but just the risk of my money, my capital.
Yeah.
So I won't touch it. And if I want to trade it, this is a point I was bringing it back to by showing the yen. It becomes part of a risk class, a risk dimension, and therefore I can trade it through some of the surrogates, the risk related. So the Ukraine flares up. It has an impact. The emerging markets and the currencies will be hit, but also it's going to have an impact on the stock market.
Yeah.
Given that I'm looking for a trade markets, which is pretty much work 96 and 90 on the DAX. Thank you very much. And that you see the signs that the yen crosses might be, or the yen might be a bit toppish, struggling on there, maybe reflecting some of the uncertainty with Ukraine. And the like, then it gives you another opportunity, another way of trading it. You don't have to go out and risk money on pegs or central bank intervention or manipulation. You can just trade surrogates, and you can look. The Hungarian,
that's a very good point.
Hungarian is part of that same basket. Hungarian has been relatively strong historically in the last 10 years. Maybe it's time, despite surpluses or whatever, maybe it's time for it to move in sync.
Yeah.
Even if it moves in sync, it's a good move. Or maybe I wouldn't argue it's going to catch up. Intuitively you would sell the Ukraine and buy Hungarian, but maybe it's time to do Hungarian against another market. It's kind of looking to pick the strong currencies and sell the weak currencies in situations like this. And then there comes a point, and this is a much harder trade, and why often it's quite useful to go with the speculative bubble, the real thrust, is to buy yourself, is to get some profit behind you, because the real trade will be to fade it. The most serious money that's made in the ERM days, and the most serious money that is made generally with these currencies, is not actually selling them, it's actually buying them at the right moment. Because then you can lock in, not only do you lock in a great price, but you lock in a massive interest rate differential that buys you comfort as well. And so you get the kickback on both sides. And how you time that? Well, your chart is always a much better, clearer guide, but it's the fundamentals that are driving you. In other words, go back to the analogy: the fundamentals are my direction, my destination. Is the chart, it's my map, my guide, and then it's my trading approach that protects my capital, that gives me the risk structure that says, is this a trade or is this not a trade? For many people, I'm sure what's going on in Ukraine is a trade. For me, the risk return, my risk return is skewed. I can look at it as an influence on other trades I'm doing, or as a trigger for other trades I might do. You know, I'm still in the South African rand, a small amount,
Yeah.
a very small amount now, and I've kept it because I'm unsure as to whether it's a top. Something like Ukraine will keep me in it, just because it's an emerging market and it's gonna carry on going. But I'm ultimately looking to fade it, and I'll probably end up cutting out on a not on a loss because I've got a lot of profit in it, but on a much lower level because
Yeah.
of going back to the conversation about sentiment and how you trade shifts in sentiment. Then this is exactly what you expect to see at the top. So kind of difficult.
Yeah.
Um, so they're the kind of ways I would look at trading Ukraine, bringing in the fundamentals,
Yeah.
how they relate, trying my best I can on markets I won't necessarily trade. Very uncomfortable trading markets I don't normally trade for two reasons. One, I'm not aware necessarily of all the regulatory risk, but also how they like to trade on a day-by-day basis.
Exactly.
So how they relate to other markets, I can look at and work out the correlations and say, this works out well. But it's the technicals and the sentiment that
Yeah.
are my map. And the sentiment is definitely against it, and the technicals and the fractals are saying, wait a couple of days, and then maybe a bigger trade here.
So ultimately, be very careful about trading stuff like Ukraine. Uh, you just can't control the risk.
Yeah, and
Trading headlines it's never a good.
it's just knowing. I mean, there's a good time for this risk disclaimer. Never risk more than you can afford to lose. Beware. Take responsibility for your actions. Be aware of what you're risking at all times. Be aware of what you're risking at all times. That doesn't mean you can't take high risk trades. Over history, it's shown that more high risk trades you take, the higher return. You like to take bigger hits, but the more higher risk trades you take, you generally should make a generally higher return. So going after situations like this is a good way of making money, putting the ethics aside.
Yeah.
But be aware of what you're risking, and that's be aware of what your risk return is. I'm going to go on about that, about the Paul Tudor Jones quote about playing. The important thing about trading is playing great defense, not offense. There's a time to recognize that the risk is too great, that you may have a view, but it's not a trade because the risk is too great. First and foremost, protect your capital. I think that's probably a good place to finish, unless
so
we
too.
can find a picture of me and my son flying on a
Well,
broom.
if you could just send it to me on Slack once more, because you sent it to my Skype and I received it on another computer.
Yeah, I don't know where. Unfortunately, I don't
I'm
know where it is.
hearing roars of happiness from the cafeteria here. People are watching the skiing. Norwegian skier broke
All right,
his what do you call it?
record, personal best,
No, what do you call the stick?
ski pole.
Yeah.
Why is that a good thing?
No, I don't know. Something happened. I have no idea.
Okay, do you want to go back to the Bruce Covenant quote? We'll finish on.
Which one was that? Bruce. I lost track now. Is that one of the?
Yes, you got distracted by ski poles.
Yeah. Sorry. So
Do you
the
ski?
first one.
As a Norwegian, you must ski, yeah?
Yeah.
That's why you're so good as a nation, as skiers.
I don't know why. The Swedes think it's doping, so. the Bruce quote.
Yeah, fundamentalists. In other words, people who trade in fundamentals, who say they're not going to pay any attention to the charts, are like a doctor who says he's not going to take a patient's temperature.
Yeah.
Ukraine's hot, and therefore you need to take its temperature. You need to take a chart and see what's going on and what opportunities present themselves. Because the fundamentals point to one way now, and they'll provide an opportunity later.
Exactly.
But unless you're clear and sure of your risk, then don't trade it.
Yeah. And then I want to end with your prince, who is in Saudi Arabia this week. And so far, it's not creating any political risk here. I've never seen him look better, to end on a lighter note.
Yeah, whether it's Prince Philip, then there might be a few political risks out there.
Yeah, he likes to talk, doesn't he?
Famously so, often misquoted. There's some great quotes from Prince Philip. Yeah, I think what's a famous one about unemployment. Couldn't understand about unemployment why people were complaining. They used to complain when they didn't have enough holiday time. Now they've got more time on their hands. They're still complaining. Yeah.
That's a different kind of political risk. It's also very hard to trade, I would think.
Well, that's
Trading his
the
travel
consequences.
schedule.
Okay.
That was a good show. I'm gonna wrap it up, and tomorrow we are on around the same time, and I don't know if we have the topic yet, but if you wanna see some of the pictures, charts, or quotes we've shown, we also share this on Pinterest. So we're quite savvy here. It was Ed's idea. And we're gonna tweet this out after. It's pinterest.com/fillorkill.
Well, it's my idea because I need a storyboard, yeah?
Yeah, it's a lovely
And you
one.
need something to draw the pictures from. So
Exactly.
it kind of, if you're going to do the work, you might as well put it out there.
Yeah, and that's a good work
Because
log.
it's interesting for Pinterest as well, because that's a possible way forward. In fact, my wife runs a nursery business, and she was saying she might actually pick up on the same concepts. So
Yeah,
it's a good way of
yeah, it's totally different from what normally it's just cupcake pictures and stuff like that. So now it's
legs. I've seen so many. No
yeah.
disrespect, not making any comment at all, but seeing so many women's legs on Pinterest. What's this about?
Yeah, I'm opening it right now. It's well, it's clothing and food really, and some exercise and some legs.
Yeah, maybe it's because I'm not interested in the clothes. I'm interested in the
Yeah.
legs or whatever. But it's
So I think it's a social network with 98% women or something like that. So we're in the minority here.
yeah, but it was starting a trend.
Not so much technical analysis there.
We're doing the Russian ruble trade.
What?
We're being pioneers. Yeah.
Yeah, for sure. First ever ruble anything on Pinterest.
Yeah.
Anyway,
Cool.
I want to thank you so much, and you have to follow Ed on Twitter. He's really good there. More of similar things and shares a lot. You can follow me as well. Here's my handle. If you have any comments or things you like, dislike, you want to see more or less of, or anything else, you can just send me a DM on Twitter. It's anyone can do it. And if not, you can send me an email at myhandle@myhandle.com. So you figure it out. And thank you so much. See you tomorrow.